Hello and welcome to my presentation about the Australian share market. It is late May and it has been a volatile experience to put it mildly. I feel like I'm a tour operator on the east coast of Australia, and I'm supposed to tell all my visitors that the sun shines every day on the east coast. And if we occasionally have a day of rain, it'll pass, because sunshine surely is just around the corner. I'm not so sure whether I'm abide to that strict rule. I know that many in the finance industry have a view that one should not scare away the customers or the potential customers. I have a little bit of a different view on this. I think honesty and straightforwardness is preferred. And I'm simply counting on the fact that investors are smart enough and intelligent enough to appreciate an honest and straightforward presentation about what may or may not expire or transpire in the remainder of the year. Having said so, this is not by definition going to be a doom and gloom story in the case of we should all move 100% in cash. But there are risks out there, and I don't think we should shy away from touching upon those risks. As you probably can tell from the title I've chosen, there are risks and there are some serious question marks we should all be asking. Having said so, I have no idea who you are. You might have a little bit of an idea who I am and what I do, but nothing I will say today can be, shall be, or should be construed as financial advice. And I think we're all very clear on that one. Those who are not necessarily familiar with what we do at FNArena. FNArena has now been in operations for more than 2 decades, and the basis of what we do is we amalgamate, we bring together all the views and ratings from the major stockbrokers in the country. Now, this allows us to come up with our own proprietary indicators and data. And this is one of the more interesting one in the current context, I believe, and that's why I'm highlighting it here. I just said we exist for more than 2 decades, but we weren't that sophisticated in the early years. So the data we're using in terms of buy, hold, and sell ratings from the major stockbrokers for ASX listed companies dates back to the beginning of 2006, which still gives us at this point in time 16 years and counting. And the interesting part here is, okay, there is, one of the criticisms is justified. Brokers are more likely to issue buy ratings and neutral ratings than they do sell ratings, and that's clearly on display here. The blue line that you see here is the percentage of buy ratings out of the total of ratings that we have of all the ASX listed stocks. The ochre line are the neutral, the hold ratings, and the green one at the bottom are the sell rates, which you can tell never reaches as high as the other two. But what is most interesting here is the correlation between buy ratings and neutral hold ratings. And on occasion, when the percentage of buy ratings out of the total reaches beyond 45%, we do get a change in dynamics in the share market. And I usually refer to that as a bear market. Now, there's no set definition of what makes a bear market. I believe that the dumbest rule that some people adhere to is it's only a bear market when it's down by 20%. But that's discussion for another time. This indicator here, as you can tell on the right-hand side of this graphic, is indicating that we are in a bear market now. We are reaching almost an all-time high in terms of percentage of buy ratings, which is now above 60% of total. And as you can tell here, over the past 16 years, we've only seen that percentage higher in 2011, when the world was really, really worried that the European Union would collapse and implode because of problems in Greece. And that also signifies that even though the market at that time didn't necessarily go down by that much, there are various dynamics that are similar to periods that we can describe as a bear market. Now, the obvious one is obviously the period late 2007 to early 2009. We obviously had the Brexit crisis, 2011, 2012, and we have smaller ones as well. We have the period May 2015 to February 2016, which a lot of people will remember, because if you owned banks and resources and energy at that point in time, you really had a tough time. And we also go to 2018, which was quite a brief one that only lasted for 4 months. And that's because the Federal Reserve at that point in time reversed course and then initiated a full recovery in equities. 2020, of course, was way too short. But what did happen is we did see the early beginnings of what would prove a steady rise in the number of buy ratings in the market. Now, this is not to open the discussion whether we are in a bear market and how severe it's going to be and how long it's going to be. I have no idea. But what I do think, and this is why I point this one out, we have to, as cautious investors, as intelligent investors, we have to, at the very least, consider now that the dynamics in the share market have changed, and what that potentially could mean for our investment strategies and our portfolios. And I, for example, have been, since the beginning of the year, I have been calling myself a cautious investor, and that cautiousness has not disappeared. As a matter of fact, I've actually become more concerned and more cautious as the year progressed, and now we're obviously approaching mid-year. We could, apart from that stupid minus 20% rule, which really is very non-intelligent, there are various technical definitions and characteristics, and you name it, and it's all open for discussion. But I think I found this definition put forward by a few academics, and I think this really describes it very, very well. Another way of putting it is that bull markets are so much more fun than bear markets. The fact that in a bear market, a company can come out and issue positive news, and then not necessarily sees a positive follow-through in the share price is to me one of the characteristics that is definitely on my mind. We follow reporting seasons very closely here at FNArena, and in February, numerous companies came out with very good results and outlooks. Yet it didn't stop share prices from falling and from selling. In more recent times, my personal experiences are that I'm a very proud shareholder in Amcor, and the fact that Amcor had performed really, really well over the opening months of the year has subsequently led that I took some profits on Amcor. And I have seen on days that the stock has, that other people had similar ideas, depressing the share price. And in more recent times, a company like Aristocrat Leisure came out with very good results and an excellent outlook. The share price in the first instance rallied by more than 10%. And I've used that rally as well to take profits on my holding, and subsequently the share price has ended up lower than the price before it actually released those results. Go figure. When I say I took profits, it means I didn't sell all the shares. I simply sold some of the shares I had in those stocks. And this is part of my strategy of how to deal with a bear market, where I believe The overall trend is sideways at best, probably downward looking, with a lot of volatility along the way, and it's very difficult to always accurately predict when the trend temporarily goes upwards or not. Why should we pay attention to the fact that maybe the dynamics temporarily have changed? Because what we do know from history is that bull markets last a lot longer than bear markets, and bull markets are a lot more fun as well. But bear markets can destroy just about anything that we enjoyed throughout the bull market. And instead of quoting other experts, I decided this time around I'll just take one of my own explanations, which I provided on Twitter recently, and I think this is what it's about. I mean, investors traditionally, and there is a train of thought that as long as you bought your shares cheap enough and you hold on to them for long enough, that you should always be okay in the end. The problem with that is that when you do encounter a serious bear market, that is not necessarily true. The damage can be absolutely mind-numbing and can be so large that it takes many years, if ever, to get back to the level at which you bought the shares. And just as a few examples from memory, Woodside shares in 2008 reached as high as $73. And today, even after the rally we've seen over the past year, they're in the 30s, which is not even halfway of that level. BHP peaked at $50. It only recently reached that point and went beyond it a little bit temporarily. The same observations can be made, for example, for Rio Tinto. And 3 out of the 4 big banks in Australia have never even touched upon the share price levels again that we saw in 2007. And many other companies, many other stocks have needed the best of a whole decade to get back to the levels where they were. So this is one of the reasons why I say to people, you have to pay attention. We don't know yet whether this bear market will prove as devastating as some of the other ones we've seen. There are various forms of bear markets. The current one is probably at face value. It shares a lot of characteristics with the market in 1994. And back then, the Federal Reserve went on an aggressive tightening path to prevent inflation from going out of hand. That year saw both investors who held bonds, government bonds, and equities take losses because both asset classes had a negative performance. But by the end of the year, the ASX was only down by 10%. So that was actually quite a mild bear market, but it did last for the better part of a whole year. Now, we don't know whether that is the scenario that's gonna unfold this year. I mean, the bear market in 2020 was very sharp, but also very quickly resolved. The bear market in 2018 lasted about 4 months and ultimately pulled down US equities by 20% and Australian equities by a little bit less. And then, of course, the bear markets in 2002 and 2007, 2009 were much worse. They lasted a lot longer, and the damage was a lot deeper. So we don't know at this stage what the outcome will be. So my advice to everyone, my logical advice, common sense, is that we pay attention, and we at the very least are prepared for things to get a lot worse. And that's why I chose the title as well. Apart from having cash, and how much cash you have is completely up to you, of course. I mean, make sure you can sleep at night. Every time this market goes in a downward spin, I personally think like, oh, I should have more in cash. Every time it goes for a very sharp rally, as bear markets do, I always think like, luckily I didn't have more in cash. I mean, that is the balance the to and froing that you go through as an investor. Apart from having a percentage in cash in your portfolio, I think the key message here is to reduce risk. And to reduce risks, we can do in lots of ways, and I will definitely touch upon that in this presentation. But before we go there, I want to share with you something that is equally important, I think, and this goes to the core of the characteristic of this particular bear market. The reason why I don't adhere to these simple rules is that it always depends on where you put the starting line and the end line and the timeline, etc. I mean, it's very arbitrary in the end where a bear market starts or where the bull market ends, etc., etc. But here's a observation that is worth keeping in mind. In the early months of 2021, things started changing in the United States. And what started to happen is that the more speculative parts of the market started to tumble, basically, to falter, to no longer stay in line with the larger indices. And those at first were the more speculative parts of the market. And then it moved on to the micro caps. And then it moved on to the small caps. And before we knew it, it moved on to the mid caps. And what you can see on this chart, the dark blue line is the S&P 500, which strictly taken, yes, has 500 stocks in there, but it's predominantly led by half a dozen of really mega cap stocks. It's the Apples, it's the Microsofts, it's the Amazons, and they really decide the trend here. But what you see in the lighter line, I would call it a greenish, silvery greenish line, that's the Russell 2000, which has 2,000 stocks, and which is sort of regarded as the mid-cap index in the United States. And you see from mid last year that the mid-cap companies were no longer moving up in line with the large cap stocks. So that was the next segment of the market to get hit. Now, subsequently, we've also seen the NFTs being hit. And if you don't know what an NFT is, I'll say Google it. We've subsequently seen in November, December that the mid-cap technology stocks got hit, and very, very hard, in a way that we haven't experienced since the TMT meltdown in March 2000, the Nasdaq meltdown back then. We've subsequently seen that all the cryptocurrencies are being hit, and then subsequently we went into consumer-oriented stocks in the United States, and those hits have been equally reflected in the Australian share market. Now, I can fully understand if investors say, yeah, but Rudy, I'm owning banks, insurance companies, I own energy companies, and I own miners, with iron ore miners in particular. I've experienced very little of all of this, and yes, and I fully acknowledge that, and that is probably one of the reasons why many people think, like, why am I making such a big fuss out of this change in dynamics in the share market? But I do think it is important, and well, for the following reason. As you can see on the right-hand side, by the way, I did publish a book in 2016, and I do like a little bit of humor. And I'm also a big fan of Pink Floyd music, which is also apparent in that photo on the right. But on the left-hand side, I have reprinted the final conclusion of the book I published in December 2016. And what this essentially says is that the bear market today is not necessarily a sell-off event for the market as a whole, and everything happens at the same time. It's more of a staged event where, almost like a ball which rolls down the hill and then hits one tree after the other one and ultimately picks up more speed as it moves further down the hill. And a strategist like Mike Wilson of Morgan Stanley, for example, he in this context talks about a rolling bear market, literally a ball that rolls and hits one segment after the other one. I have a little bit of a different view, but it's essentially comes down to the same thing. And I believe this is probably the best way to look at today's bear markets. And if I go back to 2016, I can clearly see one domino hitting the next one, and then the next one, and then the next one, and then the next one, until the last stone has been hit. And this is one of the reasons why I believe investors should be mindful of how this process is developing. Because also from the fundamental side, even if you don't want to see it as a stack of dominoes, also from the fundamental side, you can clearly see how the focus of the market and the selling is developing in 2022. And it started first with the pricing out, punishing the exuberance. It subsequently moved into fear for inflation, fear for higher bond yields, and thus the bond proxies and the higher value stocks were hit. And the focus now is shifting towards the effects of inflation on the economy and the effects of rising interest rates and central bank tightening on the economy and on corporate profits. And so, and as the attention shifts, there is more than just a logic to assume that other parts of the share market will gradually be hit, because some of those parts have been immune thus far, because they had a lower valuation and they weren't directly related to bond yields. But they might be exposed when economic growth falters and when corporate margins and corporate profits come under pressure. That is the next challenge, also what we will be facing in Australia. The fact that inflation is now impacting on how companies do business, and that means margins under pressure and current expectations probably being too high. Now, having said so, that is really one of the challenges now in portfolio management. And I've been warning for weeks now that in the run-up to August, it'll be a challenge for investors to not have exposure to companies that have to issue profit warnings or have to admit at the very least that expectations that are priced in the share market or that are assumed by market consensus that they will not be met. And there are quite a number of challenges this year. I've attempted here to name them, and I put in the middle, have I forgotten anything? Because there are so many of them. Truth to be told, none of these, including the war in the Ukraine, would be enough on their own to put this market in a longer lasting bear market, or in a bear market at all. But in combination, and in particular, the fact that corporate profits are now coming under pressure, and the fact that inflation is now on central bankers' focus on their radar. Those two elements are now the most important ones, I believe, and they both can put this market in a much stronger tailspin to the downside. And this is why they need to be on investors' attention. The most important thing, apart from corporate profits that are probably too high here, and we will find out over the next few months. One interesting thing to say here is that last year, and before anyone thinks, because you've now seen my book and you're thinking, well, he's giving another bearish presentation here. He must be the perma bear in the Australian share market. The irony was that last year, when quite a number of experts were turning negative on equities globally and in Australia, I was amongst the ones who said, no, you're way too early. I mean, and that persistence on my behalf, which at times led to me being qualified as a perma bull for a change, imagine, is because I acknowledged that corporate forecasts, corporate profit forecasts by analysts were still rising. And usually, all else being equal, when forecasts for profits are rising, the share market usually follows in the same direction. Now, if you follow that logic, and usually that is correct. Now, if forecasts this year are falling, then usually the share market, it goes into the same direction, which basically means the share market has to fall. And we are only just beginning with that process. So there's more likely than not a lot more to come in terms of falling forecasts. The other thing, which is potentially even more important, is the fact that the focus of central banks has changed, and quite dramatically so this year. And in that respect, I have observed that in particular central banks in the central bank in the United States has had a lot of difficulties in getting their message across to investors. And from this perspective, I believe that the interview that Jay Powell, the Fed chairman, gave on the 17th of May, which is not that long ago, to the Wall Street Journal, has been quite a changing event, in that investors finally started to grasp what the change in dynamics here. And the change in dynamics is that previously, because we were still fighting deflation and structural disinflation and potential deflation, so it was in the remit of central bankers to support assets and to create a wealth effect that led to more spending, and that would mean that we at least didn't go into negative inflation. But now we have inflation that's running away. It's more than 8% in the United States, although it has fallen a little bit, but it's still above 8%. And there are forecasts, for example, that in Australia, inflation is going the same way, just at a delay. And central bankers very, very cognizant of the fact that the 1970s, when inflation was really, really rampant, that was not a great time. It was not a great time for everyone who lived in society, and it was not a great time for anyone who owned bonds, and it was not a great time for people who had their money in the share market. Just talk about to any of the fund managers that lived through the 1970s, and they still have nightmares about it. It was really, it's not a great time. And that's, of course, a scenario that central banks are trying to avoid this time around. But that means they have to tighten aggressively, and they have to get inflation down. And we should all hope that they are successful in that policy, in that aim, in that target over the next number of months, because the alternative is not really something to look forward to. Even though some of you own energy stocks and obviously are hoping that oil prices will remain high for longer, but that doesn't help with inflation, as we all should know. Anyway, one of the quotes I take from that interview, it says here, and basically they're saying, we know what to do and we will do it because we have to do it. And they will take casualties along the way. And I think the share market is finally waking up to the fact that for the time being, it's very difficult to be structurally positive about equities, unless at some point the outlook for inflation, the picture for inflation changes, and then central bankers can potentially relax a little bit more as well, and maybe cool down a little bit on their aggressive tightening policies. Needless to say that we don't know whether the world is awaiting a recession at the end of this policy. But if inflation stays higher for longer, and the longer central banks have to go on aggressive tightening, the higher the chances, of course, that we will have a recession at some point. So fingers crossed, we hopefully have a little bit of pain short term, and inflation will come down pretty soon. Although I have to add as well, at this point in time, very few are expecting such a scenario. Now, That was a general picture. My crystal ball is not better than anyone else's. I do not know whether we will have a recession. If my 5 cents worth can be thrown in here, my feeling is that it's very difficult for Europe, including the UK, to avoid a recession. So we probably will see recessions there. Some of the emerging markets is probably the same story. The United States, that of course is now really dependent on for how much longer we have to see an aggressive Federal Reserve, but the longer they have to go with 50 basis points tightening and with quantitative tightening as well on top of it, of course, the shorter the odds that they will have a recession. Australia, I believe, is once again the lucky country, most likely to avoid a recession over the next couple of years. But as an investor in the share market, of course, the problem is, or the challenge is that if the US has a recession, potentially, or at least will go through a recession scare, and that is translated into lower share prices, up to what point is that will that not be reflected in the ASX? And I think that will be a big challenge and a big call to make. So I believe this is a time to have a healthy amount of the portfolio in cash for a couple of reasons. If the market does sell off, cash doesn't fall in value. If at some point opportunities open up, you need cash to make use of it. And apart from that, I think patience will be required here. Patience. Not looking unless, of course, we're experienced enough and we have all the tools available, and we think we can trade the ups and downs. The other point is reduce risk. And I've definitely been reducing risk in the beginning of the year, and I'm still reducing risk as I disclosed it a little bit early in this presentation. Now, how do we reduce risk? And I have a few suggestions here, which I also shared in a previous presentation at the beginning of the year, at a time when I was still presenting myself as a cautious investor. And one of the logical ways, I believe, to reduce risk is to concentrate on the reopening trade opportunities in the share market. Now, the reopening trade has had a lot of stops and starts and stops and starts again, because the whole COVID pandemic, closing down of societies, lockdowns, you name it, has been a less predictable process than most investors would have liked. But that has helped now, that whole reopening trade theme, to survive into 2022 and still be alive and kicking. And I believe that investors will give companies like a corporate travel and a flight center and a Webjet and a Qantas and related companies that still the benefit of the doubt, which all else being equal should translate into share prices that to a certain extent will remain supported, even if those companies may not in the short term live up to expectations. Now, we shouldn't forget that the reopening trade is a lot broader than simply travel agencies and airlines. Some of the obvious ones are obviously the toll roads, and Transurban would be one of the logical ones to mention here, but also Atlas Arteria as well. And I've summed up a few alternatives which may not necessarily be on most investors' radar. The obvious observation to make here is that reducing risk is also done by not putting too much of your portfolio in smaller cap stocks. I mean, large cap stocks, as again has been proven in recent weeks by profit warnings, which so far are predominantly forthcoming from the small cap space, is that small cap companies are more vulnerable to what is happening in society today. And large cap stocks do offer a less risky proposition. So that should be kept in mind as well, even though you might want to play the reopening trade. Now, the other observation to make is that the best performing sector on the ASX over the past 2 decades has, by arm's length, and probably by 2 arms lengths, has been the healthcare sector. Now, the healthcare sector throughout the pandemic has had a little bit of a mixed fortune. That's because the lockdowns and related impacts have also impacted on various business models. But of course, that also means that the sector, those companies are now also part of the reopening trade. And the other thing to mention also is that if you hark back to the domino theory I explained earlier, then the domino for stocks like Cochlear, CSL, or ResMed, that has already fallen. So those companies, on the assumption that operationally everything stays okay, they obviously start off from a much better base than companies whose domino hasn't fallen yet. I'm personally, I'll never make a secret out of this, I'm a very big fan of the better quality companies in the local healthcare sector, and that by definition includes Cochlear, CSL, and ResMed. I've made this little selection before there was a takeover bid forthcoming for Ramsay Healthcare. On the less obvious side, I have selected Helios and Sonic Healthcare because they were key beneficiaries of the pandemic because they did all the PCR testing. They have subsequently been sold off as a beneficiary, but we should not forget that their core businesses, of course, are part of the reopening trade, and they should, all else being equal, get a big boost from that. I'm also a big fan of looking at the quality of companies, and Sonic Healthcare is a much better quality company and would be my preferred choice in comparison to Helios. I mean, when it comes to Cochlear, CSL, and ResMed, 3 quality companies and long-term still carried by solid growth trends. The other obvious domino that has fallen is, of course, the bond proxies in the share market. And this is quite interesting because if the focus switches now to slowing economic growth and the potential of a recession, then bond yields at some point will no longer rise and they will go down again. Which basically means that the stocks like Charter Hall, Goodman Group, Vicinity Centres, Shopping Centres Australasia, Abacus Property, Ingenia Communities, and others should lift and will become more attractive. And that's the point I am personally waiting for. My big favorite in this sector is Goodman Group. I'm still convinced that on the operational side, that is an excellent company to have exposure to. It has had a little bit of a tough time this year, also because its main customer, Amazon, had been making some negative comments about the sector as well. But long story short, and I'm now also banking I'm relying here on the analysts who cover the property sector in Australia, and that's one of the advantages, of course, we have as FNArena. We see all the research and we can see what the experts are saying. I've selected here 5 segments of the local property markets that, from an operational point of view, are in excellent condition. So there should be very little problems on the operational side for the companies I line up here and for those particular sectors. The only question is, when will bond yields become more accommodative for this sector? And that should, all else being equal, mean that they have seen the lows. Now, I touched upon it earlier. Banks, financials, also including insurance companies and banks and resources stocks in both mining and energy, they've done really well this year and have led the ASX to outperform international markets. But the question, of course, is for how long, and how long can it potentially last? Because I pointed out earlier, as the focus changes to slowing growth and to potentially a recession, I wouldn't be too cocky and too confident that those companies at some point will not be hit by slowing demand and by a much lower share price. Just to illustrate how exceptional. I mean, I know that the energy sector is currently put in a different position, much more beneficial position, because we have a war in Russia, etc., and that obviously limits supply globally. There's also another element to point out here, and that's why I thought like how exceptional the circumstances have been for the mining industry locally and globally, in particular for iron ore producers, is by looking at the global dividend payers in 2021. And again, this is based on the nominal amount that companies pay out, not on the yield on the shares, which is something completely different, but this is how much companies actually pay out over a whole year. And in 2021, December 2021, BHP was the world's #1 dividend payer, the largest dividend payer in the world. And why is that important? On number 3 in the table is Rio Tinto. Number 10 is Fortescue, and number 7 is Vale, which is iron ore producer with nickel based in Brazil. Now, traditionally, this table is being, as you would expect, would be populated with telecommunication companies, banks, potentially other financials, and some oil and gas companies. Right? What you see now is that there's Microsoft in there, which is a technology stock. There's Samsung in there, which you can say like that's technology as well. It's consumer electronics. There's one telco, AT&T. There's one oil and gas stock, Exxon. There's Apple, again, one of those mega stocks. And there's one bank, and it's from China. So you see how over the past few years, the world really has changed, and quite dramatically so. But in the same respect, and I know BHP, they paid out another record dividend in February, and they are going to pay out, most likely, another record dividend in August. So they are still going to be #1 in the world this year. But one has to question for very cyclical industry as is iron ore, whether this is the peak or not. And as a cautious investor, this should definitely be on your mind. Plenty of examples over the past decades how people held on to Woodside shares because Woodside started paying a high dividend. And at one point, of course, they had to cut their dividend, and the share price was heading a lot lower, and the damage was done. The most controversial sector at this point in time, by default, is the technology sector. I mean, I am a big fan of domestic technology, and I do not necessarily stick with the label of technology. I think technology comes in various formats. Some of the healthcare companies I've highlighted earlier are essentially technology companies, and that also includes the likes of REA, GOPSEEK, car sales. I mean, computer share, although computer share strictly taken would be a financial. But most of those companies, they have a little bit of a tough time as long as the Nasdaq is being sold down. Having said so, I also believe that we have some really high quality, excellent companies on the stock exchange. Two of my favorites would be Technology One and Pro Medicus, but there's also WiseTech, there's Zero, and NextDC. They are all out of favor up until now. It's very difficult for me to make a prediction about when they will regain favor, and they don't pay dividends, so you don't get rewarded to wait in them. But needless to say, the mega trends that previously carried those companies, they're not going to disappear. They will continue for many years, and there will come a time when share prices for those companies will find favor. exact timing unknown. And at the very bottom, I've selected some smaller cap companies, which very large potential, and the big story equally applies. I mean, exact timing unknown, but definitely worth keeping on anyone's radar. Now, apart from cash and reducing risk, I also have become basically I've become in favor of owning at least some exposure to gold. And why is that? If you look at gold over the past 22 years or so, over that period, it has generated a return which is similar to the return of the share market on average. And that goes both in US dollars in comparison to the US share market, as in Australian dollars in comparison to the ASX. But the advantage of gold sometimes is that it doesn't move in direct correlation with the share market, which means that sometimes the share market can fall and gold will rise. And for that reason, I think it's worth having gold. If aggressive tightening by the Federal Reserve into a slowing economy with high inflation, if that at some point breaks the system, makes hedge funds go bankrupt, creates havoc in property markets, etc., 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 gold will back come to the fore. Gold is essentially a hedge against negative yields on bonds, which at this point in time, long story short, should be negative for gold, but gold is there as an insurance policy. It's like you take the policy because in the hope that you don't have to need it when your house burns down, but when your house burns down, you're very happy that you actually have it, because that's when it creates its value. It's the same in the share market, in my view. How much gold should you have in your portfolio? Well, how worried are you about the world, basically? And because it's not very clear what bond markets are doing at this point in time and where they will be heading and what's happening with inflation. So I don't have a very large exposure to gold, but I do have an exposure to gold. And I have exposure to gold bullion through an ETF. I know a lot of people, they like to take on gold producers, but gold producers is not quite the same. You take on, apart from more currency risk, depending on which company, there's also company-specific risk, of course. And strictly taken, gold producers are of a higher risk than gold. And you see that on this chart, which compares gold with an index of international gold producers. And this is quite interesting. This is why I include this in the presentation, and I want to make this point here. The dark blue is gold. No, it's wrong. That's the other way around. So the dark blue is the ETF that has the gold producers, that combines the gold producers, and the lighter greenish line, that is gold. And you see that at times when gold is popular, the producers will rise much further than gold does. So in essence, you're making more profits from owning gold producers in the good times. But then when gold is not so popular, you see that the blue line falls much deeper and stays there. So in not so good times, you also suffer larger losses in producers. And this is why I personally, I stick with gold bullion and not necessarily with the producers. Now, summing all this up, I'm not saying by any means that the only way forward is a sell down and an outcome similar to what we had in March 2009 or in 2002, after 2 years down the track from the March 2000 sell down of the Nasdaq. But I'm also saying that we can't be certain that this will be a copy of the bear market of 2020, very unlikely, by the way, of 2018 or of 1994. And because we can't be certain, I believe that the best way forward for investors is to reduce risk. And you reduce your risk by, if you were in cryptocurrencies, by obviously not being there, but also you reduce your exposure to smaller cap stocks. You reduce your exposure to the share market in general, I believe. You have a healthy percentage in cash. and you also add some gold to your portfolio, and you exert a lot and a lot and a lot of patience. That would be my strategy, and that is my strategy. And of course, in the meantime, you follow very closely what's happening with corporate profits and with inflation and central bank policies. Having said so, that is about the last thing I have to say about this today, at least for today. I do manage a portfolio, and that is based on my own research in all weather stocks, which have had a tough time over the past few months, but which I also believe will at some stage will come to the fore, and I actually believe that some of them already are. You can always ask me any questions about my particular portfolio or my strategies and my particular research. If you are interested in what I do and what we do at FNArena, and in some of my approaches and analysis of the share market, I, on occasion, publish a secret report, and it's easy to access that. You just put /secret after the URL of the FNArena.com website. And that also, if you make use of that, that also offers you the opportunity to have a free trial to the service we provide. And you don't have to take that up, of course, at the main, and you can do whatever you want from that point of time. And guess what? That is about the last thing I have to say, at least for now. I hope you enjoyed it. And let's just say that we revisit it at some point in the future.